Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. We're talking the 5 most common life insurance mistakes today. Life insurance is not a topic that most people love to talk about. First, it involves thinking about death, which is not always pleasant. And next, it involves spending money on premiums that offer no tangible benefit necessarily. So, it's paying money for something, it's talking about something unpleasant. It's not always a fun topic. So it's no wonder that so many Americans are underinsured. So even for those Americans who are insured, it's really common to fall into some of the common mistakes made with life insurance. So we're going to talk about 5 of the most common mistakes I see with life insurance. All right. So by the way, disclaimer, I do not sell life insurance, but I include it as part of my financial planning recommendations and the discussions I have with people. So there's no bias here behind this. These are just simply things that I've observed over time. So let's take a look at the first mistake. Number 1, thinking you don't need life insurance because you're young and single. So many people think life insurance is just for those who have a spouse or partner, possibly children, possibly all of the above. And this is mainly because life insurance is designed to replace your income if you were to pass away. And therefore, this provides financial protection and continuity for those who rely on your income. So you might be thinking if no one relies on your income, then you don't need life insurance, right? So not always the case. Even if you're young and single now, that may not be the case, forever. You may eventually be in a situation where someone is relying on your income. You might get married or live with a partner. You may have children. You may become a caretaker for an aging relative. You may end up in a situation where there is someone depending on your income. So you might be thinking, well, I'll just get life insurance if and when that happens. And this may seem logical, but the problem is life insurance gets more expensive as you get older. It also gets more expensive if you develop health issues. In some cases, you could even be ineligible for life insurance later in life. So as a result, many people end up ineligible for life insurance right when they need it the most, or it becomes prohibitively expensive. So to avoid the situation, you can lock in a life insurance policy when you're younger and healthier, therefore paying lower premiums. If your situation changes later in life and you find yourself with financial dependence, then you can update your beneficiaries accordingly as life goes on. But you've locked in that policy. So just for some perspective, I ran some quotes here. Again, these are just based on the current time I ran these quotes. Don't hold me to this. This is not something that is not, it is subject to change. So be aware. But just for some perspective, a $1 million 30-year term life policy on a 28-year-old woman in the top health class came back at less than $40 a month at the time of this particular episode. For a man, the same policy is less than $50 a month. So again, these figures are subject to change, just use as examples. But as you can see, it's not very expensive to get even a $1 million policy when you're very young. So that could be a good time to lock in your policy and have that cost throughout the life of that policy. Next, not having enough coverage. Next mistake, not having enough coverage. Many people think of life insurance as simply a way to provide a small lump sum to loved ones to help with things like funeral expenses and a few other things upon their death. This thinking results in a significant number of people ending up underinsured. The ideal use case for life insurance is an income replacement in the event of death of the person insured. So for example, let's say our family of 4 has, I'll call the partner's partner 1. This is spouse or partner who earns $100,000 a year, and partner 2 earns $50,000 a year, along with 2 children, ages 4 and 7. Obviously, these children are financially dependent on both parents. If partner 1 passes away, that leaves a dramatic income gap. The elimination of the majority of the household income would likely result in partner 2 having to significantly downgrade their lifestyle, make some dramatic life changes in order to support the family. It would be incredibly stressful and difficult for partner 2 and could have tragic financial consequences. All this would be on top of the emotional trauma as a result of the death. So all the financial trauma is layered on top of that emotional trauma already there. And a small lump sum of even a few $100,000 is not going to go very far in this situation. So this is why so many professionals, including me, recommend a death benefit of 10 to 15 times the income of the insured person. So why is it 10 to 15 times? Where does that number come from? It depends on the situation, but generally the amount of the death benefit is designed to allow the surviving partner to pay off all debts and create an income from the money. And since life insurance proceeds are tax-free, this in theory gives partner 2 some options for generating investment income that may not be 100% replacement, but could be enough to provide some financial continuity. That's the reason for that number. All right, next mistake, relying on life insurance through your job. This is probably the most common that I see, and the most significant and concerning in my opinion. So many employers offer life insurance as part of a benefits package. So it's generally called group life insurance. Normally you can get around $50,000 included at no charge, maybe more, maybe less. I mean, you have the option sometimes to buy more at a very low rate. The maximum amount of life insurance you can get through work can vary depending on your employer and the specific policy they offer. But in general, most employers have a limit on the amount of life insurance you can buy through the group policy. And this means you're likely not able to get the right amount of coverage through your job. That limit's not going to be enough to get to that 10 to 15 times income number. And more importantly, if you rely on your employer to provide you with life insurance, then your life insurance is tied to your job. So when you leave your job, you may not be able to convert your policy into a private policy. And even if you can, the rates are likely to increase significantly, or you may not even qualify. And if you take a new job with an employer that doesn't offer life insurance, or you transition to self-employment, you may end up without insurance at all. And you'll have to start over and apply at an older age, which may make it more expensive. So what's the better route? Buying life insurance through a policy that is not tied through your employer can be a much better way to secure that right amount of coverage while locking in a policy that stays with you regardless of any job changes. So for this reason, I am almost always a fan of buying private life insurance directly through the carrier, not tied to work. Therefore, it stays with you for the life of that policy and not tied to your job. Next, buying cash value life insurance. This is somewhat controversial. You've probably noticed that term life is the type of life insurance I've mentioned so far, with no mention of cash value life insurance. And that's because cash value life insurance is generally not appropriate in most situations. Cash value life insurance can come in many different forms. It includes whole life, variable life, universal life, indexed universal life, many other types of policies. They go by lots of different acronyms and names, but they all generally are cash value life insurance. And most financial products have a place and are appropriate for certain situations. Cash value life insurance can have value in certain specific situations. However, for the vast majority of people, term life insurance is the most suitable type of life insurance. Cash value life insurance is significantly more expensive than term life. And as a result, most people end up dramatically underinsured because they can't afford to buy the proper amount because it's so much more expensive. One of the selling points often promoted by those selling cash value life insurance is the fact that it's permanent because it technically does not expire, thus lasting your whole life. But most people don't need life insurance for a lifetime. Life insurance is very important in earlier stages of life, but most people don't need it later in life when they are mostly or completely debt free. They have adult children who are self-sufficient, and they've built up enough assets to be able to survive at least partially on investments. So term life insurance is ideal because it's there when you need it and it expires when you don't. And finally, cash value life insurance is often sold as an investment. However, the returns generated from these policies are often subpar when compared to investments that are more directly through the markets, like mutual funds, ETFs, inside of retirement accounts typically. And so with a few rare exceptions, term life is the ideal product for most people. So one mistake I see quite frequently is buying cash value life insurance because it's been sold to you by someone who benefits from the commissions from it. And then finally, last mistake, failing to define contingent beneficiaries. The whole point of life insurance is to provide a financial benefit to loved ones in the event of your passing. This is why you name a beneficiary on your life insurance policy. But what if your beneficiary does not survive you? That's why it's very important to also name contingent beneficiaries. A contingent beneficiary is a person who receives the death benefit in the event that the primary beneficiary does not survive you. So in many cases, this is another relative, or it can be children. It can be a trust, which can be especially useful if you have minor children who are not old enough to handle large sums of money yet. Be sure to consult a professional, of course, who can discuss estate planning with you if you have questions about the best way to name beneficiaries and contingent beneficiaries in your life insurance policy. But be sure you have at least one, preferably more contingent beneficiaries on your life insurance policy beyond that primary beneficiary. So concluding, a few statistics. I like statistics. I got these from Policy Genius, just a few things that might be interesting. Only 52% of Americans of adult Americans have life insurance. So less than, about half the country is not insured. 27% of American adults with life insurance only have group coverage. Again, that's tied to your job, not ideal. Again, we talked about this before, 10 to 15 times is the multiple of annual income that most financial advisors recommend when buying term life insurance. 40% of life insurance holders wish they had purchased their policies at a younger age. This goes back to locking in a policy at a younger age. 40% of life insurance holders, 40% of people who have life insurance, again, wish they had purchased it while they were younger. So that's very telling. How much more does permanent life insurance like whole life, cash value insurance cost versus term? 5 to 15 times more on average. How much does life insurance cost or increase in cost as you age? 4.5% to 9%. That's how much it increases in cost as you age, assuming your health stays the same. 2 to 3 times. That is how much rates for smokers cost versus rates for non-smokers. So smoking causes a pretty dramatic price increase. However, after a year, if you quit smoking for a year, most companies will offer you non-smoker rates, so you can get back to non-smoker rates. And then the difference between premiums for men and women is 24%. Women paying about a fourth less than men on average for life insurance. So a few statistics that might be interesting. And again, those are from Policy Genius. So in short, life insurance, not always fun to think about or talk about or pay for, but I would argue having the proper coverage in place can be a life-changing decision if it's ever needed. It can also bring peace of mind when you know you've implemented a plan for your loved ones in the event that you pass. I've talked to many families that I've worked with, and when they finally get life insurance in place, I hear from both of them, "Oh, we're so relieved. Life insurance is not tied to our jobs, so we know it stays with us. We have the right amount of coverage in place. We can rest easy knowing that that has been taken care of in the unlikely but tragic event that something were to happen." So that peace of mind is hard to put a price on as well. Again, I don't sell life insurance, so my bias is very objective. I have no bias there other than just making sure individuals and families that I work with are taken care of. So I'm hoping that gives you some perspective on some of the mistakes many people make with life insurance so you can avoid those mistakes. All right, with that, as always, happy to chat anytime. You can reach out at elevationfinancial.com. That is my website. Easy to find there. You can reach out, send me a message, or better yet, book a complimentary money session if you need some help with anything, if you'd like to ask some questions. That is how to get a hold of me. You can also email me at podcast@elevationfinancial.com if that's easier. All right, everyone. Thanks for joining me as always. Have a great day. See you next time.